In order to understand the function of primary markets, it is important to also understand how they relate to secondary markets, as they both have very distinct functions. Without them, the stock market would simply not operate efficiently. Knowing the individual purpose of primary markets is key to understanding how securities trade and in turn the manner in which my team and I at RC Brown Investment Management manage the MFM UK Primary Opportunities Fund. We'll help you understand how these markets work and how they relate to investors. The primary market refers to the market where securities are created by a company, known as the issuer, and are initially offered for sale at a set price, typically to institutional investors. Primary offerings occur regularly as companies issue new shares in order to raise new monies. Companies appoint an investment bank as an advisor who assists the company when issuing new shares. Their role is to speak to potential investors, gauge interest and set the parameters of the share's initial price and obtain buying commitments from institutional investors. All known available information must be disclosed to the investor, meaning we are buying at a price where we have been able to evaluate all the information. In order to encourage investors to buy these primary offerings, we would expect shares to be offered at a discount to where we then expect them to trade in the secondary market. Discounts are driven by size of the issuance, liquidity of the shares and demand for its stock. Often discounts range between 2 and 10% to the prevailing market price. In addition to the discount, primary opportunities are typically free of stamp duty and commission. For fund managers like RC Brown, these opportunities provide a price advantage that will create additional alpha in all market conditions. We are buying at a discount to the market price, providing us downside protection. Small investors are often unable to purchase securities in primary markets as they are typically the preserve of institutional investors. On completion, the shares can trade in a secondary market where investors buy and sell among themselves. Transactions that occur on the secondary market are termed secondary simply because they are one step removed from the primary market, which is where the transaction took place that originally created the securities. It is what people typically think of as the stock market. The national exchange in the UK is the London Stock Exchange, though companies from all over the world seek to list in London. Unless a company is buying back its shares, it has nothing to do with sales in the secondary market between two investors. Primary market prices are set in advance when all information is known to the market. Prices in the secondary market are determined by the basic forces of supply and demand. If the majority of investors believe a stock will increase in value and rush to buy it, the stock's price will rise, perhaps beyond that of its true worth. If a company loses favour with investors or fails to post sufficient earnings, its stock price declines as demand for that security falls. The primary market serves a very useful economic purpose. It facilitates capital raising by companies for future growth. Unlike distressed businesses in special situation funds, primary opportunity companies are typically healthy and seeking further growth by way of additional capital investment for expansion, acquisition or debt reduction. The method of buying primary opportunities falls into 4 categories. The most well publicised primary market transactions are initial public offerings, or IPOs. But there's a lot more to primary markets than just IPOs. A primary placing occurs when an existing quoted company issues new shares to raise money, usually for expansion or acquisition purposes. Then there are secondary placings or sell downs of existing shares by a known seller, for example strategic or forced sellers, which is typically by private equity, founders or management. This kind of secondary placing is common in the years following an IPO, whereby those large shareholders at IPO reduce their holdings in the future to satisfy investor demand for the stock. Lastly, sub-underwriting and buying the rump of rights issues, where sub-underwriting provides useful income and where we, as investors, might look to buy the rump of the issue, i.e. those shares not taken up by existing shareholders. Investors are given the right as existing shareholders to buy additional shares in a company at a discount to the prevailing market price based on the number of shares they already hold. Some shareholders may not take up their rights. These shares, known as the rump, are then offered to institutional investors. Usually we expect around 5% of rights not to be taken up, so the rump placing can be tens of millions of pounds or even larger than that. Primary markets offer institutional investors wholesale access to new company securities when they begin trading on the London Stock Exchange. With access to all available information, investors have complete transparency, allowing knowledgeable investment decisions to be made. Discounts available in the primary markets, together with very little by way of transaction costs, make primary opportunities a compelling purchase. The team at RC Brown have spent many years fine-tuning our primary opportunities investment process. Having run discretionary mandates in this way since the company's formation in 1990, we then launched the MFM UK Primary Opportunities Fund in 1996. This provides investment advisors access to these primary opportunities that are otherwise eluding them and therefore their clients' portfolios.